Hi everyone, welcome to today's video. So let me start today's video by talking about the story of Jyoti Resins. This is the video that I had done on that particular stock and the date is approximately 6 months ago. So let me present a very quick analysis what has happened with that stock in the last 6 months. So here is the analysis and you will see that in the last 6 months the stock has given 155% return. Now you will say, Akshat, you are a brilliant investor and you would have invested all of your money in this particular stock because you knew it was going to give an uprun and you would be sitting on billions and billions of dollars right now. The answer is no. I made money on this stock, but I invested a very little portion of my entire investment on this stock. More importantly, when we are starting our stock market journey, what we tend to do is that we try to find these type of multi-bagger stocks. And I can say this with certainty that no one can predict these multi-bagger opportunities. That's a second key point is that when you're starting out your investment journey, it is very important to keep the sustainability in mind. You have started investment as a habit and you are likely to have a 40-50 year investing career ahead of you. So please be patient. Please understand the system. Please don't run after these multi-bagger stocks, and at the beginning, you should not even be investing in these type of companies. So with that viewpoint in mind, on this particular video, I'm going to help you understand the system as to how you can invest your first 25,000 rupees in the stock market. In case you're an advanced level user in the stock market, still watch this video because there are a lot of basic things that I will talk about that we typically tend to forget. So I'm going to recap everything and systematically present the viewpoint as to how to build an investment system through which you can easily invest 25,000 rupees a month in the stock market buying stocks directly. So let me speak in a point-wise manner and please listen to all the points carefully, prepare notes, only then this video will make sense. Otherwise, if you watch half the video, implement half the learning, then you will end up making losses in the stock market. So point number one is that what exactly can you do with 25,000 rupees in the stock market, and why should you even bother investing 25,000 rupees in the stock market? Is it going to help you generate enough corpus? So the answer is absolutely yes. You can easily invest 25,000 rupees a month in the stock market. If you have that amount, if you have lesser amount, let's say 10,000 rupees or 5,000 rupees, that is also okay. So let me run 2-3 computations and through this, you will understand the compounding math very, very quickly. So here I'm showing you the data for 25,000 rupees. Even if you are able to increase your money at just 12% CAGR growth, you will be able to make approximately 60 lakh rupees within 10-year time period. So this is decent amount of money. Now you'll say inflation will happen, inflation will not happen. Yes, inflation will happen, but people who invest and are able to grow their money at 12%, they are much better off compared to people who just keep on talking about inflation and keep writing weird YouTube comments that, you know what, inflation is going to eat money. Inflation is going to eat everyone's money. That does not mean that you should stop investing. So this is part one of the math. Now you might say that, hey, I don't have 25,000 rupees to invest. It's a lot of money. So what about 10,000? Will I be able to create a decent corpus with 10,000? So here is the math for that. So again, you will see that you are able to build out a decent size corpus just by investing 10,000 rupees a month. And also I'm stressing on the fact regarding inflation that yes, inflation will eat into this corpus. But think about it this way, that right now assume you're 25 years old and you are able to put only 10,000 rupees in the stock market on monthly basis. Now with time, with inflation, even your salary will increase. So your principal investment in the stock market will also increase. So therefore I'm not factoring inflation into this discussion. So I hope this particular point helps you understand the power of compounding in the stock market, and hopefully with this viewpoint you will at least think about investing your money in the stock market. So naturally you will have a question that, hey, in what method should I invest in the stock market? Should I go and invest via mutual funds? Should I go and invest via small cases? Or should I go and directly purchase equities? So I will explain you the pros and cons of all three methods very, very quickly. So number one is mutual fund investing. So what exactly is mutual fund investing? It is collection of stocks or collection of bonds, and that briefcase is called as a mutual fund. So hypothetically speaking, if a mutual fund manager purchases ITC, Hindustan Unilever, Britannia, and collects and picks these three stocks, keeps it in a briefcase, that becomes a mutual fund. On the flip side, what is a stock? A stock is an individual company. So when you are purchasing mutual funds, what exactly you are purchasing? You are purchasing a portfolio or briefcase of stocks. Now, what is the advantage of mutual fund investing? The advantage is that, hey, you don't have to manage your money per se. There is a mutual fund manager. You are giving your money to that mutual fund manager and they are managing your portfolio on your behalf. So this is the great part. Some people say that, hey, this money is professionally managed, so we should give our money to professional managers. Also correct, no doubt about that. But here is the problem, that there are almost 1500 mutual funds there in the market. So which mutual fund you should pick? That itself becomes like a headache. I had done a separate video on that. You can go and check it out. There are hosts of other problems with mutual fund investments as well, that sometimes we don't check the expense ratio. Sometimes the mutual fund house itself does some scam, and there are hosts of different problems in terms of investing in mutual funds. Then comes the second option, which is the small case option, and they are the sponsors of this video. And it's not as if that I'm just going to say nice things about them and not explain the negatives. So let me explain the pros and cons of a small case. So the primary advantage of small case is that those are easier to understand. Why? Because small cases usually are thematic driven or theme driven. For example, let's say that you're very bullish about the rural economy, or you are very bullish about manufacturing. Then you can go pick that particular theme and invest in that particular small case. So this is the primary advantage, that they are much easier to understand. The negatives are that, again, there are expense ratios associated with certain small cases and you are losing out some amount in form of commissions. So this is the primary negative side. Now, if you don't want to pay commissions, then you need to do what? You need to do direct stock investing. You need to go and start a demat or a trading account and start investing in the market. But what is the advantage or disadvantages of buying stocks directly? The primary advantage is that you don't need to pay additional commissions that you have to pay in small cases or in mutual funds. What is the negative? The primary negative is that you must know about the stock markets. If you don't know about the stock markets, then it can become a very bad decision on your part to go and directly invest in stocks, because you stand to lose a lot of money. So I hope these basic categorizations of primary options available to you is clear. Now, with that viewpoint in mind, let us move to point 3. Now, on point number 3, let me give you a very quick crash course as to how you should consider investing. The most important thing here is that you must understand the risk-reward equation. Now, what is the meaning of risk-reward equation? So let us break apart the reward part first. Reward simply means return. So for example, let's say that you purchased Hindustan Unilever at 2,500 rupees, and now that stock has given a run up and it has reached 3,500 rupees. What is your reward? Your reward is 1,000 rupee per stock. 3,500 minus 2,500. So reward is very easy to understand, but what is the level of risk that you are taking when you are purchasing that particular stock? This is an aspect that people have a very hard time figuring it out. So let me break down the risk part of it. So primarily, risk comes from 5 specific things. The first and foremost is the size of the company. For example, earlier on when I started the video, I talked about a company called as Jyoti Resins. Now that is a small cap company. It is somewhat of a competitor to Pidilite. Now if you look at the market cap of Pidilite, it is much bigger compared to Jyoti Resins. So what is the key message that I'm trying to give you? I'm trying to tell you that, hey, if you are picking small cap companies, they have much higher chances of growth, but the risk that you're taking, that is very high. But when you move to large cap companies, which are big companies, your risk goes down in terms of the company size. Second key thing is that the risk also comes from the type of sector that you are considering to invest. For example, when you are investing in finance stocks or tech stocks, those sectors are high growth sector. They have something called as high beta. High beta simply means that the market, if it goes up by 100 points, these finance or tech stocks are likely to go up by 120 points. But when the markets fall by 100 points, it is very likely that these sectors, for example, finance, technology, are slightly more volatile and they might fall by 120 points also. So please understand high risk sectors versus low risk sector. This is where the second category of risk comes from. Now the third category of risk comes from the price of the stock itself. So let me pick the example of Adani Green, and this is not a recommendation from my side to sell or buy the stock. I'm just using it as an example. So here what you will see is that within a year, so this is November of 2020, and within approximately an year and a half, this stock almost became 3x. Now what happens is that when this type of a run up is happening, what people do is that they will start buying stuff here or here or here, and consider someone who had purchased a lot of this quantity of stock here. What are you doing? You are taking a lot of price risk for the stock. This is trading at an all-time high and you are investing your money over and over again on this stock. It might come down. There is a very high chance that some level of profit booking will happen in this stock and you will lose some bit of your capital. And you can see that the stock corrected quite a lot. It corrected by almost 35-40% at its bottom, and this is when people start panicking. Now, very quick disclaimers here that for advanced level users in the stock market, it is okay to purchase some stuff at its all-time high. But for majority of the beginners, even if you're buying really good stocks, always try to figure out that there is at least a 10% gap from its all-time high and from your purchase price. If that is the buying price that you are getting, it is somewhat okay, but please do not invest in huge amounts when they are trading at a premium, because when it comes to advanced level users in the stock market, they can still do business analysis, they can do fundamental analysis. You might struggle with those aspects and you will start trembling the moment the stock that you had purchased, it falls by 30-40%. You would not know why it is falling, whether you should be holding, not holding, and you will unnecessarily book a lot of losses. So the third related point is the risk of the price associated with the stock. Then the fourth type of risk is called as the macros risk. So you might be reading a lot of news sitting on 19th of August that, hey, stock market has fallen by roughly 1.5% today. Why? Because the inflation considerations are there, this, that. Now, here is the problem with news that number one, you are going to get a lot of articles, and your head will hurt if you start reading all those articles. Second key point, you would not know what is correct to assume and what is incorrect to assume. So therefore I say that please don't consider news, consider analysis. Analysis is more important because at least it gives you some insights on which you can act. But if you simply just keep on consuming news, you will get hurt, and therefore people have trouble understanding macros. They will just look at news and they will start trading. That is a horrible way of investing in the stock market. Now comes the final point or the final risk, which is the business risk of a business. Now, business risk simply means that, for example, that Pidilite is an established player in adhesive space in India. Now, Jyoti Resins, which is a new upcoming emerging player, it is taking market share away from Pidilite. Now, you have to do a business analysis and make a call whether Pidilite will be able to fend someone off like Jyoti Resins in the market and will be able to retain its market share. So this is business analysis. This is complex. This is something that I spend numerous hours on teaching on my stock market course. So I can't do it via a video, but this is something that you need to understand in case you are building direct positions in certain types of stocks. And therefore it is said that stock market investing is a highly complicated game. Please get into it only when you understand the space a little bit better. Otherwise, check some of my small cases in the description box. I have aggregated those. You can go and check it out. At least I have filtered some of the stocks for you. So the next point is around diversification of stocks. Now, what is meant by diversification? Because we often get a question that I want to invest 25,000 rupees, but how many stocks should I consider buying? So at the very least, you should purchase between 10 to 20 stocks. How did I get that number? Because I call this number as a 5 to 10% rule. For every stock that you are purchasing, you should not have a holding of more than 5 to 10% on that particular stock. So let's say that there are only 3 stocks in your portfolio, ITC, Hindustan Unilever and Pidilite, and you are investing in equal amounts. Then what is the portfolio allocation? It becomes 33.33% per stock. Now, if something bad happens to even one company, your portfolio overall will tank quite a lot. What you are doing in this scenario is something called as concentrated form of investing. Please do not do it. This does not mostly work out for retail investors. It's a very high risk strategy. What I recommend is that you should invest between 5 to 10% of your money on every stock that you're purchasing. So if you have to invest 25,000 rupees, how many stocks you should purchase? You should purchase between 10 to 20 stocks. So now comes the next point, that how you should purchase stocks. So there are 4 specific points that I would outline. So first and foremost, for every one aggressive stock that you purchase, please have 2 defensive stocks when you are starting out. So 66% of your portfolio should be defensive, only 33 to 40% of your portfolio should be aggressive. Now, what are aggressive sectors? I have spoken briefly about it. This could be tech, this could be finance, these could be small cap companies, these could be companies like Jyoti Resins. So your portfolio in terms of aggressiveness should be on the lower side, and your portfolio on the defense side should be slightly higher. For example, these would be FMCG companies. So these are regular oriented products. They do not change too much in value, and therefore when you analyze the price chart of HUL, here is the price chart of HUL, you will see a linear growth on these type of stocks. Why? Because these are somewhat defensive sectors. So this is the first key point that you need to understand. Second key point, please follow the margin of safety that I have spoken about in terms of price, in terms of lowering your risk. Your goal at the start of your investment journey should be fairly simple. It should not be to make insane amount of money. It should be survival, that you end up surviving in the market for 20, 30 years, automatically money will be made. So please don't worry about that. Just figure out low risk strategy at the beginning, and then with time, as you gain more confidence, you can complicate your strategies further. Then let's move on to the third point, that you should buy low debt companies. There is so much talk about Adani stocks these days, but analyze any Adani stock and here is how the debt situation looks like, and this can be analyzed by going on screener, and you can take a look at a ratio called as debt to equity ratio, and you will find that for almost all Adani stocks the debt to equity ratio is very, very high. It is okay if you want to invest in these type of companies, but please understand that you are taking higher unit of risk here. As a beginner, you should not be running after such things. Now, fourth and finally, you should mostly purchase large cap companies. But here is the problem. So here is the price chart of Nestle, and you will see that it approximately costs 18,000 rupees to purchase one Nestle stock. So now you will say that, Akshat, I really like Nestle. It's a defensive stock. Everything good. I want to purchase it. But my investment amount is 10,000 rupees or 20,000 rupees a month. So how I can go about purchasing something like Nestle? So this brings me to the next point, which is called as building your position. So this is what your investment journey could look like if you're starting out with, let's say, a lower amount, let's say 5,000, 10,000 rupees. So let's assume that you're investing 10,000 rupees in the stock market. So let's say in month one, you purchase something like TCS, which costs roughly 3,000 rupees. Then you purchase Reliance, then you purchase one more stock, and your 10,000 rupees get exhausted. So how many stocks do you have? You have 3 stocks only here. What is your goal? Your first goal is to get to how many stocks? At least 10 stocks. So next month, you don't purchase these type of stocks unless you are getting them at a very good price. Then you add 3 more stocks here. So let's call them DEF stocks. You can easily purchase them. Now, how many do you have? You have 6 stocks. Similarly, you keep on doing, and then by 5th month, what is your portfolio size? Your portfolio size becomes 50,000 rupees by 5th month. And if you then have to go and purchase Nestle on the 6th month, can you do it? Yes, you will have to wait probably for 1 more month because you need 18,000 rupees. So wait for 2 months. Don't do investing for 1 month. Do it the month after that, aggregate at 20,000 and add Nestle to your portfolio. So this is called as building your position, and this also gives you an opportunity for opportunistic buys. Now, what is meant by opportunistic buy? For example, in the last 6 months, the markets have been falling quite aggressively. So that was an opportunity to aggregate more stuff. So you go take a look at your portfolio that, hey, I have this portfolio. Which stocks can I consider buying out of these 10 stocks that I have in my portfolio? So whichever is giving you the best risk reward equation at that particular point in time, you should buy that stock only. Because some months you will find that pharma stocks are running. Then some months you will find that, hey, pharma is undervalued. Now tech stocks are running. Then what do you need to do? Whatever is running, please don't run after that. You need to purchase something that fits your risk reward equation. I hope that through this video, you understood the entire process step by step as to how you could invest your money in a very easy to understand fashion. Thank you so much for watching, and I will see you soon.